The Dow Jones just crossed 53,000 for the first time ever. Not a rumor, not a projection. It happened this week. And if you are wondering whether that number actually matters to your money, it does. But not for the reason most people think. The celebration around this milestone is completely understandable. Markets hitting record highs feels like good news, and in many ways it is. But here's what the milestone is actually pointing toward. The conditions that pushed the Dow through 53,000 are different from anything we have seen in recent years, and the sectors leading this move are not the ones dominating financial headlines. Let us break this down from the beginning. The rally this week was led by chip stocks. Semiconductors surged. The Nasdaq jumped sharply to start the week, and the Dow briefly crossed that historic threshold before pulling back slightly. Now, when chip stocks lead a market rally, most people assume it is purely an AI story, and yes, artificial intelligence is part of it. But there is a bigger picture forming underneath the surface. Three economic forces converged this week that rarely line up this cleanly. The first is the labor market. U.S. monthly job gains have improved meaningfully in 2026. The year-to-date average is sitting at 92,000 jobs per month. Compare that to the 2025 average of just 9,700 per month. That is nearly 10 times faster job creation year over year. The second force is inflation. WTI oil prices have fallen back toward pre-conflict levels after a sharp spike earlier this year. Gas prices at the pump have been slower to come down, but the trajectory has shifted. Analysts are now saying inflation may have peaked, and that is a meaningful change from where we were just 90 days ago. The third force is the Federal Reserve. Under Chair Kevin Warsh, the Fed appears likely to hold rates steady for the rest of 2026. No hikes and no cuts either, at least not yet. But for markets, that kind of stability is often exactly what they need to keep climbing. When borrowing costs stop rising, corporate earnings get more predictable, and more predictable earnings tend to support higher stock prices. Hold that thought, because it connects directly to where the real opportunity sits right now. Most people watching the Dow cross 53,000 assume the gains are concentrated in the same handful of tech mega caps, and to some degree they are. Nvidia, Microsoft, Amazon, Meta, Alphabet. These companies remain powerful and well-positioned, but something is shifting in how institutional money is being allocated heading into the second half of the year. The sectors drawing the most attention from industrials and just technology includes suppliers and communication services, covers media platforms, broadband infrastructure, and yes, parts of the AI value chain. What these two sectors share is exposure to both economic growth and the AI build-out simultaneously. That dual exposure is becoming increasingly attractive. Think about it this way. A pure AI software company lives and dies on adoption curves and subscription growth, but an industrial company supplying power infrastructure to data centers, it benefits from AI spending regardless of which AI platform wins. That distinction matters enormously right now, and most everyday investors are not holding these sectors in any meaningful way. There is something else worth paying attention to. Emerging market stocks are quietly being positioned as a serious alternative to U.S. technology exposure. Earnings growth in emerging markets is forecast at more than 50% this year. That is not a small number. That is a structural shift in where global corporate profit growth is being generated. Brazil, India, parts of Southeast Asia, and select parts of Latin America are all contributing to that growth picture. And for everyday investors who have a portfolio that is almost entirely U.S. focused, which describes the majority of individual investors globally, that represents a real gap. Not a reason to panic, but a reason to look at whether your portfolio is capturing any of that growth. If you are finding this useful, consider subscribing for more practical financial insights. Now let us talk about what this Dow milestone actually predicts for the months ahead, because milestones like 53,000 are not random. They tend to mark inflection points, not always the beginning of further gains, sometimes the beginning of a period of consolidation. The key variable for the rest of 2026 is earnings season. The coming weeks will reveal whether the valuations currently attached to U.S. stocks are justified by actual corporate profits. Analysts are projecting 14 to 16% earnings per share growth across the S&P 500 this year. For the mega-cap technology companies, that expectation has some support. For the other 493 companies in the index, that would represent a doubling in earnings growth pace compared to last year. That is a bold expectation. And markets have a well-established habit of punishing bold expectations that do not materialize. But here's the other side of that equation. The companies that have genuinely integrated AI into their operations, not just talked about it, but built it into their workflows, are already reporting wider operating margins. Companies using AI effectively are averaging 17% margins. Companies that are not are averaging 13%. That 4-point gap translates directly into stock performance over time. So the question is not really whether AI matters, it clearly does. The question is, which companies are actually generating real financial results from it? And the answer to that will come out during this earnings season. So what does all of this mean if you are an everyday investor sitting with a portfolio right now? A few things worth considering. 1. The labor market stabilizing is genuinely good news for the economy. It reduces the pressure on the Fed to make sudden policy moves. That stability tends to support equities over bonds in the near term. 2. If inflation has peaked and oil prices continue their current trend, consumer spending power should improve modestly in the second half of the year. That benefits sectors tied to discretionary spending and services. 3. The gap between AI adopting companies and non-adopting companies is becoming measurable in earnings data. Understanding which companies in your portfolio fall into which category is worth knowing. 4. The industrial sector rally is not just noise. Infrastructure spending tied to data center power demands, grid modernization, and manufacturing reshoring is accelerating. These are not speculative bets. They are companies with real contracts and real revenue. And 5. Global diversification is not a concept for later. Emerging market earnings growth at 50% plus is happening right now. Whether any portion of your portfolio is capturing that is a question worth asking this week. The Dow at 53,000 is a number that will be in the headlines for a few days and then be forgotten. What will not be forgotten is whether you use this moment to think clearly about your financial position. Milestones change headlines, but conditions change portfolios. The conditions right now, steadying jobs, easing inflation, a patient Fed, and broadening market leadership, are worth taking seriously. The people paying attention to this moment will thank themselves later.